people are just really following trends. People are really just blindly following people online without having done the work themselves, right? You should always do your own due diligence and research before investing. Of course, I'm a firm believer in that. And of course, don't even listen to me, right? Don't follow me. Don't listen to me. Cross reference, reference check, right? And build a philosophy, a hypothesis around investing before you spend your hard earned money, right? And I'm going to actually read this word for word verbatim. You can look this up on what financial education is. It's the process of acquiring the skills, because financial education is a skill set, right? Investing is a skill set, and the knowledge needed to make informed and effective decisions about your finances. And it's crucial for building a secure financial future, not tomorrow we're looking to get rich, but 10 years from now, 15 years from now, 20 years from now, if you're consistent enough, if you have the right opportunities that come to you, you might be able to do it in 5, right? Things like that. Now, I'm not saying that you can't get a spark or a chance of luck. It comes with spending time in the markets and not trying to time the markets, right? You don't time the markets, you spend time in the markets. You'll have a hard time if you're actually timing the markets. If you're timing the markets, which means you're trying to get in at the very bottom and you're trying to get out at the very top, you will see that your results aren't going to be as optimal as you would like. Reason being is because if you're trying to time the bottom, let's say you jump in and it's not quite the bottom, but you feel like you're losing, you're at a deficit. That's not a problem at all. You can keep averaging down. Or let's say you try to time the bottom and that bottom that you think is going to happen never happens. And then the markets go on a massive rally. Now you just missed out on a bunch of amazing gains. And that's not what you want to do. You don't want to miss out on those gains and those opportunities because, of course, understanding compounding is your friend. The more time you spend in the markets, the more time compounding gets to work for you. And the more time compounding gets to work for you, the more exponentially those investments are going to grow over time. Okay. That's how it works. So you don't want to time the markets. You want to spend time in the markets. So financial education is the process of acquiring the skills and knowledge needed to make informed and effective decisions about your finances and is crucial for building financial structure. So first, one of the first components is going to be earnings and income. Earning and income. Spend less than you make, reinvest your profits or your earnings, and of course, avoid catastrophe. Those are 3 keys that I picked up from Charlie Munger over time, which basically is just saying if you earn $10,000 a month and you spend $10,000 a month, you're essentially gonna be flat. You're flat for the month. The average person today spends $1.25 for every dollar that they make. Now you're operating in the positive, which is where a lot of people don't operate because the next part of financial education is budgeting and spending. Okay. If you're just joining me on TikTok, I am doing my podcast on here, and this is financial education. This is the Boring Investor series. I'm Stock Market J. This is the Boring Investor. Budgeting and spending, the next component of it. Assets put money in your pocket, whether it's regularly or whether it's monthly, whether it's passively, whether it's actively, who cares? Assets put money in your pocket. Liabilities take money out of your pocket. You have to understand the two. Are you spending your money on liabilities which don't generate you a return? Or are you putting your money in places where it can work for you, where it can grow, where it can appreciate in value? And that's known as an asset. 10%, you take your check, your full check every time. This is before you even pay any bills. 10% is going to be saved in a high yield savings account. We're not putting it in just a regular checking account to not earn any interest. That doesn't make sense. Your money should be working for you, even keep it liquid. So 10% saved, 10% invested. So that means your investment accounts. I personally invest in silver, physical silver, not digital silver. I invest in physical silver. I like tangible assets as well. And then, of course, equities. And I have some REITs that I invest in as well. This is a method of diversification, but this is also investing. Like I said, you invest 10%, you save 10%, and then you tithe or give to a worthy cause. If you invest $250 into the S&P 500 every single month for 30 years, you'll have $1 million. From the moment you're 18 to the moment you're 50, you'll be a millionaire. That's just investing in the S&P 500 that annualizes between a 7 and 10% return per annum over the course of, let's say, the last 50 years. That's 30 years of investing versus 30 years of saving. So 30 years of investing can yield with a 7% return into the S&P 500, which is just an index of the largest 500 publicly traded American companies. In 30 years of that versus 30 years of trying to get those 100 grands to add up for you. What you see the difference? That's 700 grand in the same time span that you're missing out on. Those are what's known as opportunity costs. I invested in high yield savings accounts and T-bills, which were paying between 6 and 10% just for having money sitting there, which is crazy. I bet a lot of people didn't take advantage of that because they didn't know. The more you learn, the more you earn. Operating in a low interest rate environment, a lot of people make a lot of money because debt is so cheap. When you can marry that together, one more point, market and economic cycles. The economy goes through cycles, booms and busts known as contractions and expansions, or recessions, depressions, and then of course, like I said, just those good times, progressions is what it's known as. And they have troughs and they have peaks, bottoms and tops, and everything in between. Those are cycles. You have to be able to navigate each of those cycles. In those cycles, guess what you have? The markets are going to be flipping. You have different sectors in the market. And when that happens, you'll have, let's say, 3 to 4 sectors will be up, the other will be depressed and down. That happens, what you want to do is position yourself. And this just is financial education. This is just you picking up these little nuggets over time from being, like I say, you're not timing the markets, you're spending time in the markets and you're educating yourself. So you know that when these other sectors in the markets are down, that's when you invest because you want to buy low. You understand that they're great companies and they're fundamentally still growing because, as I said, oftentimes a business's fundamentals can become detached from the company's actual stock price. The fundamentals can become detached from the price. When that happens to the downside, that means you buy shares, you pick up shares of a company that is wildly undervalued and is on sale. Share this video if you're watching on TikTok. Share this video. And when that happens, you're able to buy low, allowing compounding to take its effect, meaning you have to spend time. Compounding needs time. Compound interest is the interest that your interest makes, and time is the biggest component and exponent. So compound interest is just the capital principal investment raised to the power of time. That's the exponent. And the longer that time is that you're in the markets, the greater that it is able to grow and compound. And guess what? After you reach a certain point, takes off to the moon. If you take something from someone, take the meat, leave the bones. Take what works, cross-check and cross-reference with other sources, read books, read articles, do your due diligence, and you'll make wise financial decisions. And I'm going to end with this. If you're asking people, is this a good investment? If you're asking people, when should I buy? If you're asking people, when should I sell? If you're asking people, where should I put my money? Man, you probably shouldn't be investing. You might want to spend some time educating yourself. And until next time, invest in family. Peace.